It's the only show in town. At least 17 hours, I think it is, to go before we get that decision.
Yes, that's right. And we are expecting a downshift in the pace of hikes to 25 basis points, which is pretty consensus. And that's because of December CPI had clearly continued to decelerate, giving them room to decelerate from 50 basis points. No summary of economic projections in this meeting, but we do think that the statement and the press conference will be very important.
Now, this is going to be the key, isn't it? I mean, because you can then get a sense of whether it being I suppose, a dovish or a hawkish cut, as it were. And, you know, with the data being data dependent, sometimes you've got to ask yourself, what data are they dependent upon?
Yeah, that's true.
I mean, because you can look at inflation, you can drill down and have a look at all sorts of other measures as well while you're at it.
Yeah. No, the data is clearly decelerating, but their tone is still remaining quite hawkish. And that's because we think that the Fed is still haunted by the ghost of Arthur Burns, where in the 60s and 70s, they cut rates as soon as inflation data rolled over. And that led to a series of stop-and-go policy changes.
In Arthur Burns' defense, he couldn't foresee what was going to happen with the oil shock and various other shocks that we got afterwards.
Yes, that's true. And so right now, when we look at the data, it is clearly decelerating, and some are actually already in recessionary territory. Take, for example, the index of leading economic indicators, now clearly in recessionary territory, ISM numbers, and then, other things like shelter, which is still artificially high. So right now in the CPI component, shelter is still at a pretty high.
And it's the biggest component, is it not? So this is the thing. But it's still what people have to spend money on. That's the point.
Yeah. Well, but see, the shelter component is a survey. Whereas if you look at the real numbers, like Zillow or like apartmentlist.com, rents are clearly rolling over in the United States. And so we think the next component within CPI to roll over will be that stubbornly high shelter component.
But again, we have the markets telling you one story and the Fed another, and you've got this dichotomy. It's as though investors don't buy the Fed.
Yeah, there is that saying, don't fight the Fed, but this is the Fed that came to us with inflation is transitory, right? So we think that the narrative right now, higher for longer, which is their mantra right now, is the new transitory, in that last time the market led them to raise rates higher. This time we think they actually lead them lower. We think the narrative or the roadmap will likely be they will get to about 5% terminal rate. They're going to try to keep it there, maintain that hawkish tone, but then financial conditions will start to tighten, and then unemployment rate will start to rise in the second half of this year. Non-farm payroll, we think, still healthy right now, but that trajectory is heading towards zero towards the fourth quarter of this year. And anything below 100, you start to see unemployment rate rise. So we think that by the second half of this year, there will be room for them to finally pivot and potentially cut.
I mean, you could argue they're normalizing rates, going back to the old normal.
Yes.
This is it. And that would give them the weaponry to fight a next recession where not relying on extraordinary measures, which they have been in the last decade or thereabouts. Very quickly, Jonathan.
Mm-hmm. They are trying to move back to a more normal interest rate regime, but there's still that balance sheet that they have to reduce through QT, which they're doing. So it's some ways off from normal, but we think that a combination of QT and when they get to 5%, rates are going to be increasingly restrictive. Recently, we did see real yields rise quite a bit because of inflation expectation dropping.